a free masterclass with that objective in mind, so that any challenges that the candidates face in terms of the accounting standards can be discussed. And this is going to be a weekly exercise now. In the last week, we did the first session, and that was, we introduced IFRS 15 and understood the five-step model, so on and so forth. Today, we'll take this discussion ahead. Now, towards the end of the session, there will be a Q&A part where you guys can raise specific issues that you have encountered and points that you want me to focus on. So, apart from that, any other queries that you have regarding the CA course, regarding any other course, more than happy to answer all of those questions towards the end. In the meanwhile, if you feel that you want to type out certain questions in the chat box, please type out those questions and I will address those as well. Okay. So in the last session, what we did was we understood step one of the five-step model, and we understood what is revenue and how revenue and income are not exactly the same thing. Today we'll talk about the second step, which is identifying the separate performance obligations. And we'll of course move to the step three, step four, transaction price, so on and so forth. So let's begin with that. So our first discussion was on identification of the contract. We understood what we mean by commercial contracts with a commercial substance, contracts without a commercial substance. Today, our focus is going to be on identification of the separate performance obligations within a contract. What is a performance obligation? Performance obligation is something that you have promised to do. So anything that you have promised to do under a contract is a performance obligation. Now, certain contracts might contain multiple obligations, multiple promises made. Other contracts might contain only one. You walk into a MACD, you order a burger, the burger is delivered to you, single performance obligation. You join you join my classes, for example, and the promise is to teach you, to conduct a test series and give feedback, and to prep you for job interviews. There are three performance obligations here, three separate promises. Now, the thing about separate performance obligations is they are identifiable, that is, they are separable from each other, point one, and they are capable of being sold separately. Which means if you are coming to me for a session on IFRS, and you that is a single performance obligation, but you are coming to me for FR coaching, and you are coming to me for test series, and you are coming to me for career guidance. These are three separate activities that are promised to you. These three activities can be sold independently also, they can be sold as a bundle also, but in the bundle they can be separated, they can be sold separately. It is not necessary that they will have to be uh, that they have to be sold as a bundle. They can be sold individually as well. Now, say when you are trying to identify how many performance obligations are there, it's necessary to separate them, because fulfillment of each performance obligation will be necessary to check for you so that you can account for revenue. Say there are three performance obligations. Obligation one is teaching you FR. Second performance obligation is conducting a test series and giving you feedback. Third performance obligation is helping you with job interviews. And the whole bundle I am charging, say, 40,000 rupees from you. Now, within that bundle, once I have finished teaching, I can recognize the revenue with reference to teaching. Once I have finished testing you on, you know, conducting your test series, then I can account for the revenue for that particular activity. I mean, there could be cases, where although there are multiple items that you are delivering, it could still be a single performance obligation. Back in the day when, I was around 12, 13, computers were, of course, becoming more and more popular. Those days we did not have laptops, we only had desktops. And if you are from that generation, or if you know anyone from that generation, those days now we had a concept of assembled computers, which means the CPU would be from one company, the monitor would be from another company, the keyboard would be of some company. And I enter into a contract with Praveen and I tell him, Praveen, uh, I want to buy a computer system. Can you deliver a computer system to my location? Praveen says yes. So what has Praveen promised? He has not promised that he will give me a monitor or he will give me a mouse. He has promised to come to my location, assemble all the components together, and set up my computer system. So his promise is to deliver the entire assembled computer system. That is one performance obligation. Although these items are separable, the terms of the contract are not to buy one monitor, one keyboard, one mouse. The terms of the contract are to set it up all together in one place, and that is assembling the computer. Each of these items can be sold separately, but the contract that we have, that I have with Praveen, is to set up an assembled computer system in my house. The second type of contract could be, say, for example, I want to construct a building wherein I want multiple classrooms and everything. I call a construction contractor and I tell him, please construct a building for me at this location. Now, what goes in the construction of a building? You will have, there are bricks and cement and sand and foundation and iron and steel and so many different things. But the contract, see, and these items can be sold separately in the market also. I can go and buy sacks of sand, I can buy kilograms of cement, I can do so many different things with it. But my contract with the builder is not for sale of these individual items. My contract with the builder is, you come to my location, you do whatever it takes to construct the building for me. So although the constituents can be sold separately, the contract is not for individual transfer. The contract is for the entire construction of the entire building. So that is one performance obligation. These are not separate performance obligations. So whenever we are talking about performance obligations are dealt, you have to understand what is the promise. Is the promise to deliver sand and cement and bricks and everything separately, or the contract is to construct the entire building, in which case it will be a single performance obligation. This step of identifying the separating the performance obligations, you will appreciate the step better when we do step 3 and step 4, which relate to transaction price and the allocation of transaction price. So let us understand what exactly is the transaction price. This is the price or the amount of consideration that is promised under the contract. What is consideration? Something received in exchange. I deliver a laptop to you and I get 30,000 from you. So the amount of 30,000 that has been promised under the contract is my consideration. So consideration is amount promised under the contract. Any amount to which an entity expects to be entitled in exchange for transferring the promised goods or services to a customer. And in this case, you have to remember that amounts collected on behalf of third parties are not included. What does that mean? Today, if I'm a seller whose turnover exceeds, say, for example, the GST registration limit is 1.5 crores. My turnover exceeds 1.5 crores. I have to collect sales tax or GST on that transaction. Say the rate of GST or sales tax applicable is 18%. So what I have to do is, I will be collecting the amount of sales tax from my customer and depositing that with the government. The sales tax does not belong to me. I'm only collecting it on behalf of the government of India. So what accounting entry do I record? I record, see, 1,18,000 is receivable from the customer, but my sales income is only 1 lakh. My revenue is only 1 lakh. 18% or 18,000 is my GST. Okay, 18,000 is my GST, and the reason why 18,000 is not included in my revenue is that this 18,000 is an amount collected on behalf of the government. This amount does not belong to me, hence it is not included in my revenue. I collect 18,000 from my customer and I deposit that 18,000 with the government as per my due date. Now, transaction price If you just go with the dictionary meaning of transaction price, it is the amount promised under the contract. If I teach you FR, you pay me 30,000. If I come and deliver vegetables to you because I'm Blinkit, I am charging you 500 rupees. That 500 rupees is my transaction price. But as you understand other aspects of accounting for revenue, you will realize that the word transaction price or how to calculate the amount of income has multiple nuances. Let us understand each of these nuances in detail. There are four nuances that we will be discussing today. The first one is variable consideration. The second one is financing component. The third one is non-cash consideration. And the fourth one is consideration payable to a customer. Now, pay attention. What is variable consideration? Variable means something that is not fixed. But this is not the only definition of the word variable consideration. Let us see what IFRS 15 has to say on this. If a contract includes variable consideration, then an entity must estimate the amount it will be entitled to. IFRS 15 says that this estimate can only be included in the transaction price if it is highly probable that a significant reversal in the amount of cumulative revenue recognized will not occur when the uncertainty is resolved. Let's take let's take one example. Suppose I join a gym. Okay, that I have a different example written here, but let's talk about something that I need the most right now. I really need to hit the gym. I join the gym and I pay 10,000 as my uh, monthly charges for the gym. There is a personal trainer that I appoint. And what is the deal with the personal trainer? The deal with the personal trainer is simple. I tell him, you help me reduce my weight by 10 kgs, I will pay you 5,000 extra. Okay, you help me reduce my weight by 5 kgs. By 10 kgs, I will pay you 5,000 extra. The trainer is very excited at the prospect and he says, yes, sir, I will help you reduce your weight by 10 kgs. I'm standing at the start of the month of January. This is my New Year resolution. I pay him 10,000 and I also pay him the remaining 5,000 with the condition that if you are not able to help me reduce my weight by 10 kgs, you have to return the 5,000 to me. He has collected a total amount of 15,000. Now I want you to think from the trainer's point of view. Okay, what is the trainer thinking right now? I have collected 15,000. 10,000 is his monthly gym membership. 5,000 is the additional amount that I will be entitled to if I help the client reduce 10 kg. Now, if this is an experienced trainer, that means he has past experience of helping clients lose their weight. He knows that he has had success on most of the occasions in the past in helping clients reduce their weight. So what he does is, in his mind, he is very clear that by the time the uncertainty is resolved, when will the uncertainty get resolved? The uncertainty will get resolved at the end of the month of January. He is very, very sure that I will be able to help Satyamed reduce his weight by 10 kg. So when he collects 15,000 from me, there is no doubt in his mind about the fact that he will be able to help me reduce my weight by 10 kg and he will not have to return the 5,000 to me. So the chance of reversal of this amount is minimal in his mind. As opposed to that, what if this is a new trainer? A new trainer does not really have the experience because this is the first time he's working on such an assignment. He is not very sure about whether he will be able to help me reduce my weight. So when he जब वो मेरे से 15,000 लेगा, when this client takes 15,000 from, sorry, when the trainer takes 15,000 from me, new trainer, he is not very sure. Usko maybe he will be able to get success, maybe he will not be able to get success. When will the uncertainty be resolved? Uncertainty will be resolved at the end of the month of January. And on 1st of January, what does he think? He is not sure whether a reversal of revenue will happen or not. In fact, he is quite certain that there will be a significant reversal of revenue in the future. He's pretty sure that there will be a significant reversal of the amount in the future because this is his first assignment. Let's go back to what the accounting standard says. The estimate can only be included in transaction price if it is highly probable that a significant reversal in the amount of cumulative revenue recognized will not occur when the uncertainty is resolved. When we were talking about an expert trainer, in his case, it was highly probable that reversal will not take place because he has past experience which enables him to come to this conclusion. So in this case, the expert trainer will include 10,000 plus 5,000, 15,000 as his revenue. But the new trainer, he is, in his case, it is not highly probable. He's very doubtful because he does not have experience. He thinks कि अगर मैं deliver नहीं कर पाया तो पैसा वापस करना पड़ेगा. So chances of reversal of revenue are pretty high. Because chances of reversal of revenue are pretty high, IFRS 15 says that in such a case, you should not include the amount. In such a case, you should not include the amount in your total transaction price, and you should not consider that as revenue. In that case, that 5,000 should be treated as advance from customer. If later on you help the customer reduce the weight, तो उसको revenue recognize करो. If you are unable to help the customer reduce the weight, you will have to return the amount to him. Okay, again I will read the provision and then let's go through the example on your screen. IFRS 15 says that this estimate, what was the estimate? 5,000 additional fees if you help the client reduce the weight by 10 kg within a month should be included in transaction price or can be included in transaction price if it is highly probable that a significant reversal in the amount of cumulative revenue recognized will not occur. Okay, significant reversal in the amount of cumulative revenue recognized will not occur. In this case, what is the situation? The situation is expert trainer है तो reversal of revenue का chance बहुत कम है, not highly probable. Include that in the revenue. नया नया trainer है, chances of reversal are quite high because उसके पास experience नहीं है. He might fail, he might succeed. You don't know at this point. So new trainer के case में don't include 15,000 in revenue, only include 10,000 in revenue. With that in mind, I would want you, I would want us to go through this example once. Okay, this is a similar example, but created for the coaching business. Okay, so I charge 20,000 from each student for SBR. SBR is a paper. This is my fixed fee. And my agreement says that if the course is completed before 5th of November, I will be entitled to another 5,000 from each student. I recognize 25,000 as revenue from each student, and I have 10 such students. Okay. On 15th of September, when my batch starts, I record an entry bank account debit to revenue from the batch. If I do not complete my course by 5th of November, I will have to return 5,000 to each student. And in that case, I will have to reverse 5,000 worth of revenue already recognized. Either I will debit sales return or I will have to debit revenue. My accounting entry will be sales return account debit to bank account. Because I have not fulfilled the commitment of completing the syllabus by a particular date, I will have to return the account. Now, return the amount. If based on past experience, I'm 90% sure that the batch will get completed by 5th of November and there will be no situation of a reversal happening. Like, we saw above, I should recognize full 2,50,000 as revenue. But if I am teaching for the first time, I'm not sure whether the syllabus will be completed, then a reversal might happen and I don't have any confidence about that. So I should record only 2 lakh rupees as my revenue and let the 50,000 sit in either advance from customer or variable consideration from customer. If you finish the batch on time, transfer it to revenue. If you don't finish the batch on time, you will have to return the amount that you have received from the customer. So this is the basic idea about variable consideration. But I was sharing my screen all this while. You couldn't see, yeah? Guys, you are not able to see the screen. The screen was on. You can see. Okay. Okay. And okay, so on the variable consideration part, uh, any questions that you guys have, please let me know. Any questions whatsoever on the variable consideration bit? I'm sure you have seen this in your CA final, in your ACCA, everywhere. I'm sure you have seen this. But if there are any questions, more than happy to, address them right now. No one? How many years will it take to do what? This will be resolved in 3 months. Okay, CFA. Guys, okay, questions I will take later. All the questions I'll take later. Please don't worry about it. So this is the basic idea behind variable consideration and how exactly should you account for variable consideration. Now, if there is a right to return the goods, okay, if there is a right to return the goods, then that part also will be dealt with in a different way. Okay, that part also will be dealt with in a different way. Let us understand how. Let us understand how that part also works. Say for example, I have sold the goods to customers and I have sold 10,000 units. And based on past experience, I know that out of 10,000 units sold, some 50 units are returned by the customers within 1 year. So when 50 units are returned by the customer, I know that out of the, if I account for full 10,000 worth of revenue, I will have to reverse 50 units ka revenue in the future when my customers return the goods and they ask for their money back. So, as per IFRS 15, if I have sold the goods with a right to return, and based on past experience, I know that a certain percentage of goods are going to be returned in any circumstance, then I should not recognize that as revenue and keep it parked in a separate account called uh, variable consideration from customer. Okay. So let's have a look at one such question which talks about the variable consideration bit. Nardone enters into 50 contracts with customer. Each contract includes the sale of one product for $1,000. The cost to Nardone of each product is 400. Cash is received upfront and control of the product transfers on delivery. Customers can return the product within 30 days to receive a full refund. So the timeline allowed by the supplier is 30 days. If you return the goods within 30 days, then he will have to return the entire amount to you. Nardone has significant experience estimating returns for this product. It estimates that 48 products will not be returned, which means he estimates that 2 units will be returned. Okay, he estimates that 2 units will be returned. How should the transaction be accounted for? That is the question. Now, Nardone sold how many units? He sold 50 units. Total amount received was 15 to 1,000, that is 15,000. When 50 units are sold, 48 units are not returned, but 2 units are returned. And when 2 units are returned, you will have to return the cash to these customers. So there is a high probability that the amount that you have received from the customers will have to be reversed in the future because past trend suggests that this will happen. So, what Nardone will do in such a case is, although he has received cash for 50 units, he will not recognize the revenue on all the 50 units. He will recognize a revenue only on 48 units in total. So, what is the entry to be recorded at the time of sale? Bank account debit 50 to revenue account 48,000, and you will not credit revenue with the additional 2,000. You anyway credit provision for refund because based on past experience, you have reason enough to believe that certain get returned in the future. Okay. And because you have reason enough to believe that certain units will get returned in the future, you should not credit. the first place. Later on, when the uncertainty is resolved, at that particular point in time, you can reverse the revenue. When the goods are returned, then you don't have to reverse the revenue. You debit provision for refund and you credit bank. If the customers do not return the goods within 30 days, then debit provision for refund and credit revenue. But the whole point of IFRS 15 again goes back with the idea of prudence principle. So, what IFRS 15 says is that we don't want you to be in a situation where you first record revenue for 50, then you record a sales return for 2 units in the next year. We don't want all of that. We want you to make a we want you to make a studied assessment of how many units do you think will stay and how many units will be returned. For those units which you expect a return, do not account for revenue. And instead of doing that, you credit it to provision for refund. In the future, if a situation of refund so arises, then naturally at that point, you can credit you can credit your revenue account later, but till that point you should avoid crediting revenue. Again, this is in lines with prudence principle. Do not overestimate your revenues and gains, but when it comes to expenses and losses, you should be at the forefront of doing it. This is such an Indian concept now. Sometimes if you think about it, I'm sure your parents say, and now even you say, na, "Arey, if something good is happening, don't tell the people nazar lag jayega," right? That is the very principle which IFRS 15 has adopted. Don't tell the world that you are earning revenue unless you are very, very sure of it. लोगों की नजर लग जाएगी आपके revenue को, तो don't account for it. Account for it only when a significant reverse, that the chances for reversal are minimal. Only under those circumstances will you account for a reversal. Okay. Now, let's talk about the presence of a significant financing component. Okay. Now, I want to go for a trip to the United States. Okay. And I approach a tourism company, Thomas Cook. Okay. And I'm sure you have heard of Thomas Cook. When you approach Thomas Cook, what does Thomas Cook say? Oh, this is the package and it is a 15-day trip and you will pay this much amount, so on and so forth. And you really want to go for the trip, but you don't have the money. In this case, what will people do when they don't have the money? Either they will cancel the trip, or what they will do is they will cancel the trip, or they will go to a bank. They will take loan from the bank. Say the price of the trip is 2 lakh. Okay, price of the trip is 2 lakh. They will go to the bank and they will borrow 2 lakh rupees from the bank. They will come and they will give this money to Thomas Cook, and then they will say, okay, now take us for a trip. Okay, and Thomas Cook will then take you for a trip. When you come back from the trip, you do know one thing. What do you know? You know that whatever money I have borrowed from the bank for this trip, that 2 lakh rupees has to be returned to the bank anyhow. So you will pay that 2 lakh rupees to the bank along with a good enough interest, which could be 12 to 15%, for example. So this is how normally things work, right? In the financing department, when Thomas Cook realizes that people are taking loans to go for trips, what will Thomas Cook think? Why should I let State Bank of India take the extra income? I will only offer them a financing service. So next time you walk into a Thomas Cook office and you tell them ki, "Arey nahi, I have to take loan from the bank," what Thomas Cook will do is they will say, "Listen, wait, you want to take a loan? Take it from us now. Don't pay for the trip right now. You come back after you go for the trip, you enjoy the trip, and you pay us after 1 year." So what Thomas Cook has done in this case, Thomas Cook is the travel company. What they have done is they have told you, "Okay, aaj pay mat karo, pay later." And then you ask them, "Okay, how will this work?" You tell the you tell the customer, ki, "Listen, sir, you go for the trip right now. If you were to pay for the trip today, you would have to pay 2 lakh rupees. But if you are paying after a year, you pay 2 lakh 15,000." I'm like, "Ha, okay, chalega." So what is this 15,000 that you are paying to the travel operator? This is not an amount you are paying for the sightseeing or for the trip. This is the amount you are paying to the travel operator because he gave you a facility to delay the payment. Okay. This is the amount that you are paying to the this is the amount that you are paying to the travel operator because he gave you the facility of delaying the payment. So isn't this a little like interest? Whenever somebody gives you the facility to delay the payment, that person charges extra money from you, and that extra money charged is called as interest. In this case, Kushagra wants a trip to Amsterdam. Thomas Cook says, do the trip today and pay 1,25,890 after 1 year. This person Kushagra was extremely excited to go for the trip. तो इज लाइक यार इंस्टाग्राम पे फोटो डालना है, दुनिया को बताना है, तो ट्रिप पे तो मैं जाके रहूंगा, भले ही लोन पे जाना पड़े. So he goes for the trip and he has to pay 125,890 in future to the travel company. So 125,890, the amount that he will pay in the future is the future value of the consideration. So if 125,890 is the future value, then and the rate of interest is 9%, your question should be एक साल के बाद दिया तो 125,890. What if I pay the amount today? How much will I have to pay? In such a situation, what you will have to do is you will have to calculate the present value of 125,890 on today's date. Once you calculate the present value of this 125,890, say that present value comes to 1,15,500. Now the price of the trip is only 1,15,500. But when Thomas Cook is charging 125,890 from you, the additional amount that the travel company is charging, this is not for going on the trip. This amount that the travel company is charging is not for the trip, it is for the facility of the delayed payment that they are offering you. Hence, this amount does not get credited to interest, it gets credited to your finance income. Okay, so revenue is basically income from the main business activity, correct? Revenue is basically income from the main business activity. So, in this case, as you can observe, 125,890, the entire amount is not for the main business activity. Only a smaller amount of 1,15,500 is for the main business activity of travel and tourism. Okay, the remaining amount is for the facility of delaying the payment. Okay, the remaining amount is for the facility of delaying the payment. And which is why the idea that, you know, full 125,890 or whatever the amount is cannot be considered as revenue. Your revenue amount will only be 1,15,500. The remaining amount goes and gets credited to your finance income. Now, whenever a situation like this presents itself in front of you, that the customer is buying the goods from you today, but he is paying after 6 months or 1 year, that is after the passage of a significant amount of time, then what you should do is you should calculate the present value of the amount to be collected in the future. Okay. You should calculate the present value of the amount to be paid in the future. The difference between these two is your finance income. So, how do you calculate the present value? Whatever is the amount payable in the future, uska present value nikalo into 1 upon 1 plus r raised to n. That amount is your revenue. The remaining amount is your finance income. I'll make you guys go through one question to understand how it works. But before we do that, any questions that you have, please feel free to ask me. When I say questions right now, questions about the significant financing component, your career related or course related questions, I will take up towards the end. Don't worry about that. But if you have any questions about this, uh, do let me know. Okay,
Sir,
you please. Okay.
can you
Uh,
explain the calculation once?
yes, yes, yes. I'll explain the calculation. No problem. So, I enroll in XYZ Academy for CA final course. Okay. And XYZ Academy tells me that if I pay, अरे spelling गलत हो गया. If I pay today, I have to pay 1,25,000. Sorry, XYZ Academy tells me that it has a facility which allows the students to first pay later. And when the student pays after 1 year, he has to pay 1,78,000. Now, if the student, see, the student is paying after 1 year, and after that the student has to pay 1,78,000, the rate of interest in the economy is 10%. Now 1,78,000 is payable after 1 year. That is 1,78,000 is the amount payable in future. Okay, 1,78,000 is the amount payable in future. So 1,78,000 is the future value. I need to know how much amount should I be. Okay, I need to know what is the value today of this 1,78,000, which means if I were to pay today, how much would it cost me? Okay, so to calculate the value as on today, I need to calculate the present value. Okay, to calculate the value as on today, I need to calculate the present value. Now, present value of anything is amount into 1 upon 1 plus r raised to n. Okay, so in this case, how will I calculate present value? It is 1,78,000 into 1 upon 1 plus r. What is r? Rate of interest is 10%. What is n? N is 1. So what will be the present value? Present value will be 1,78,000 into 1 upon 1 plus 10% raised to 1. 1,61,818. Okay, 1,61,818. Now, if present value is 161818, if I pay today, I have to pay 1,78,000. Sorry, if I pay today, I have to pay 161818. If I pay after 1 year, I have to pay 1,78,000. Now, for XYZ Academy, for XYZ Academy, क्या है? 1,61,818 is income from providing the main service. ठीक है? And इसका जो difference है, 16182, 16182 is income earned by way of providing facility to customer to delay the payment. So 16182 is your interest income or finance income. 161818 is your present value. How do you calculate present value? Present value is whatever amount into 1 upon 1 plus r raised to m. This is the standard formula that you have to follow. Let's have a look at the calculations. Do let me know if there is anything that you want a clarification on.
It's clear now.
Perfect. Okay. So we looked at variable consideration, we looked at significant financing component. I want to show you one question on how does the company account for this. Okay, have a look at this one. Rudd enters into a contract with a customer to sell equipment on 31st of December 2001. Control of the equipment transfers to the customer on that date. The price stated in the contract is 1 million and is due on 31st of December 2003. Amount is payable on 31st of December 2003. Sale has happened on 31st of December 2001. So the amount is payable after 2 years. Okay, so the seller is offering you the facility of delaying the payment. Naturally, there is a significant financing component. But here, when you are calculating the present value, how will you do it? Present value is this into 1 upon what is the rate of interest right now? 1 upon 1 plus 10% raised to 2. 826446. Okay, this is the present value. So on 31st of December, what entry will you record? On 31st of December, you will record an entry customer account debit to revenue account. Yes, usually हम revenue account use नहीं करते हैं. We credit sales account. Now, this money was receivable from the customer. Okay, one entire year passed by. 31st of December से जाके you are now on 31st of December 2002. Still the customer has not paid you anything. Naturally, you will expect him to pay you interest. Your entry will be by customer account debit to finance account. Okay, by customer account debit to finance account. Kitna? 826446 into 10%, 82645. Now, what is the balance on customer account on 31st of December 2002? कितना बैलेंस होगा? 826446 plus 82645, 90901. But the customer did not pay on 31st of December 2002 also. One more year passed, still the customer did not pay you. So after 2 years from today, that is 31st of December 2003, one more year has passed, still the customer has not paid you. And now what was the amount outstanding? It was 909091. So this into 10% customer account debit to finance income. Now, what is the balance on customer account as on 31st of December 2003? Last year it was 909091 plus or finance income was added. So it was 10 lakh. Now, on 31st of December 2003, now the customer paid you and now now you received the money and you recorded the accounting entry bank account debit to customer account. ठीक है. So this will go to your revenue, but this will go to your revenue. 82,645 will go to finance income in the profit and loss account. It will not be written in the revenue. It will be written in finance income in year ended 31st of December 2002. In year ended 31st of December 2003, this will be written in your finance income in the second year, and then in third year to hai nahi, fir you will end up collecting the cash from the customer. So this is, and why did we study this? We studied this because we did not, or we should not include the entire 10 lakh as your revenue. Only a part of that can be considered as revenue. The other part, which is the amount charged for uh, which is the amount charged for the facility to delay the payment, is known as your finance income. It is also written in P&L, but not in the revenue section, not in the, it does not go in the calculation of gross profit. These are other incomes. This is not income from the main business activity. Okay, now with that in mind, let's discuss. So there are only two more components left: non-cash consideration and consideration payable to customer. Yes, Neha, tell me. Yes. Can you tell me your query, or you can type it out, whatever works for you. You can unmute and speak.
Hi, sir. Actually, I was asking that in P&L, it will not show finance income. It is just come in cash flow statement, right?
No, in fact, in year 2 and year 3, it will not come in cash flow statement.
Okay.
See, this is the additional amount that you will collect from the customer for giving him the ability to pay later.
Yeah.
Hence, it will get credited to P&L account, but this is not your main business income. So it does not get added to revenue, it gets added to finance income. Like, you have interest on fixed deposits,
Right.
similar type.
Okay. Okay. Under finance income, we will credited this amount.
But when you prepare profit and loss account, there you have now, you start with profit before tax. You add a non-operating, non-cash expenses, and you subtract all the non-operating incomes, right? So there
Yes.
you will subtract this, but that is a separate point.
Okay. Okay.
ठीक
Right.
है?
Okay. Thank you for clarification.
Welcome. Now let's talk
Sir,
about.
sir, can you please clarify if it will come in PNL or not? I missed that part.
It will be credited in P&L, but not in year ended 31st of December 2001. So in year ended 31st of December 2002, this amount will be credited to P&L. In year ended 31st of December 2003, 9099 will be credited to P&L. ठीक है?
Basically, it will come under interest section, right?
Yes, it will come under interest. That is right.
And another part, it will be shown in cash flow.
Cash flow mein, if you remember in the operating activity part, what you do is in operating activity you write down less non-operating incomes, right?
Yes,
जहाँ
yes.
पे आप इंटरेस्ट इनकम माइनस करते हो, जहाँ पे आप प्रॉफिट ऑन डिस्पोजल ऑफ मशीनरी माइनस करते हो, वहां पे ये भी माइनस होगा.
ठीक है.
ठीक है? ओके, चलो. Now non-cash consideration. Non-cash consideration is any. So if I am selling goods to Neha, for example, I am enrolling her for my CA final class. Then Neha says, ki, sir, I don't have cash right now. Can I give you 10 shares of Reliance? I'm like, very happy. Give me 10 shares of Reliance. In that case, my revenue will be recorded at the fair value of the share of Reliance on that particular date. So if Neha is giving me the shares right now, what is the price of one share of Reliance? It's somewhere around 1245. I think that's the number. Let me just check. 1256. Okay. 1256.85 is the value of one share of Reliance today, right now. So she says, sir, I will join. Satyamit, I will join your class and I will pay you this. I'll give you 10 shares of Reliance. So in that case, what will happen is I will record the revenue. My accounting entry will be investment in Reliance shares account debit to revenue, because I'm not paying cash. I'm getting these shares from her as a part of settlement of the transaction between us. So if there is a non-cash consideration, the non-cash consideration is recorded at the fair value on the date of transaction. Okay, and now one last part of this discussion is uh, okay, just one second. Last part of this discussion is consideration payable to customer. Now, this situation is more common than you could think. Suppose I'm a consideration payable to a customer means amount that I have to pay to the customer. Say I am a baker. I'm baking cakes, but I'm very lazy. So yeah, I don't want to go out and buy the raw material. So when a customer places an me, I tell him कि तू ही raw material लेकर आ. So this person, when he comes to my shop, he brings material like eggs and wheat flour and sugar and milk, everything with him. The price of these items is 1500 rupees. I'm going to charge 5000 rupees for the wedding cake that I'm making for this customer. So amount receivable from the customer is 5000, but amount payable to the customer is 1500. IFRS 15 says that if consideration is paid to a customer in exchange for a distinct good or service, if it is for a specific good or service, then it should be accounted for as a purchase transaction. Okay, IFRS 15 says you are not allowed to net it off. You cannot do 5000 minus 1500 and show only 3500 as revenue. You have to show 5000 as revenue, 1500 as purchase. This is consideration payable to a customer for a distinct good or service. Okay, this is consideration payable to a customer for a distinct good or service. Now, uh, the second situation is consideration is payable to a customer, but it is not against a distinct commodity or service. Say, for example, I go to a crossword store, or I go to a Manyavar store, or I go to any of these stores, and they have now a loyalty card system. Now you know how the loyalty card system works, right? I show so every time I go and purchase something, you credit points to this loyalty card, and after 1 year, उस कार्ड में जितना भी पॉइंट्स होगा उसके proportion में you are going to give me some amount. Now, a lot of companies, a lot of retail stores have this particular policy that they will give you loyalty points, and against that loyalty point you will receive some cash or something from the company. Now I have been purchasing kapda from the Manyavar store for a while, and then I go there for wedding shopping, and my bill is 20,000. Now I tell them, don't pay me cash, settle this 1,000 against my bill. Now the 1,000 that Manyavar has to pay me, that 1,000 is not for a distinct good or service. It is basically for, it's basically loyalty points accumulated over a period of time which are being credited to me right now. So in this case, IFRS 15 specifically tells you do not account for this as a purchase. In this case, net it off and write only the balance amount in your financial statements. Consider only 19,000 as your revenue. ये example में 500 है. So in case of consideration payable to a customer, if such consideration is for a specific good or service, then account for that amount as a purchase. Do not net it off. If it is not for a distinct good or service, you have to net it off and show only the net amount as your revenue. So these are four aspects of the discussion on transaction price. Before I open the floor to questions, I would want you to quickly glance through it, and then I'll open the next part of the discussion, which is answering individual queries that you people have. And scroll it. पढ़ लीजिए इसको एक बार अच्छे से. Okay, I'll just scroll this for further reference. Just go through it once, and then of course we'll address all individual questions that you guys have. Fair enough. Fire away, guys. All questions that you have, do let me know. Before we move ahead, if you have some other concept in mind, you need to ask me about something else, and you want to stay connected, I'm giving you my LinkedIn profile in the chat box. You can always connect with me. And if you want me to take up another accounting standard, so right now we have started revenue, I will continue with revenue in the upcoming weeks also. We have covered step 1, step 2, step 3. But if you want to connect in the if you want me to take up, say, financial instruments, if you want me to take up something like a consolidation, whatever it is, then you have to let me know, and I will arrange those sessions accordingly for you. Now, can I have a show of hands? How many of you are ACCA students? How many of you are uh, CA final students or any other course? So any ACCA, please raise your hands. Okay, 5, 6. Okay, 7. Okay, okay, fair. And how many of you are CA students? Please raise your hands. Okay, understood. So, do let me know, guys, whatever it is that you would want to study next with me. Of course, we'll first finish the discussion on revenue, and then we'll go into other topics that I have mentioned. And please connect with me so that your whatever queries you have, whatever thoughts you have, I can make a note of that and plan the future sessions accordingly for you. And once that message, that connection request is there, and that message is there in my uh, chat box, then naturally, I get to plan also in a better way, and I can plan your sessions accordingly. Any other questions that you have, please let me know. More than happy to take all of them. None. Yes, Tripti, boliye, tell me. Okay, so for the last session, the recordings are on my YouTube channel. I'll send you a link for my YouTube channel also. I'm learning the online game dheere dheere. So I'm not fully proficient with it. The only thing I know is I know how to conduct classes. Everything else I am still learning right now. So this is the link to my YouTube channel. Oh God, this channel started talking. Wait. Huh. This is the link to the YouTube channel. Now here I'm uploading different topics. Like the last session was also uploaded here. This session will also get uploaded. And there I'm doing other topics also. Costing ka bhi hai, FR ka bhi hai. So basically whatever students ask me, according to that, I'm building the channel. Yes. First session, Rishi, is on the channel. It's uploaded. No, it is uploaded, but it is scheduled for release tomorrow. So kal wo release ho jayega. Okay, how does consideration payable impact financial statements? Consideration payable is a current liability or a non-current liability, depending upon when exactly you are going to pay the amount. And once the amount is, when you settle the amount, it is consideration payable to bank. Yes, Anuja, you have something to say. Guys, do stay connected because there's no other way, because LinkedIn is one place, which I also access in a very regular way. So I would request you to stay connected there, and whatever questions you have, whatever you want me to take up for future reference, I will keep on doing that. Alonso, I am planning to start. Yes, Ankit, tell me. Okay, I think those were all the questions that you guys had. Uh, just posting the LinkedIn this thing once again. Okay, non-cash consideration. See, when non-cash consideration is where instead of paying cash, the other entity is giving me something else apart from cash. So, Shiny, if I am selling, if you want to join my FR class, and you say, sir, I don't have cash right now, but I have 10 shares. So I'm like, okay, give me 10 shares of Reliance. So the amount at which I will record my revenue will be the fair value of these 10 shares on the transaction date. Because I agreed to receive 10 shares in exchange for the service that I am providing, that will be considered as my revenue. Okay, perfect. So that's all for today, guys. Step 4, step 5, again, important steps. I will be taking these up in the next session that is scheduled in the next week. And I'm repeating, if apart from that, there is anything that you want me to take up, be it consolidation, be it whatever, just let me know. And LinkedIn is the best way for us to stay connected. So, more than happy to, address all your concerns. I'm also giving you my phone number in the chat box. If you need anything, you can connect there as well. Okay. Thank you so much, everyone, and have a good day. Thank you. Thank you. Thank you, everyone.
Thank you, sir.